Hello everyone, I'm Jing. Our topic today is exotic options. In the next few moments, we will explain the exotic options characteristics, types, and their principles. First, let me start by introducing exotic options. Exotic options are a variation of the US and European option styles. Exotic options are different from plain vanilla products that are created by financial engineers, and exotic options are a product with non-standards. That means that exotic options are more lucrative for derivatives traders than plain vanilla products. And exotic options are divided into many categories, such as barrier options, binary options, basket options, etc. Next, our group member Chen will introduce you to binary options.
Okay, I'm going to introduce the binary option. Binary option is very famous around the world, and it's more like a gambling instead of investment because if you win the game, you win the war. If you lost the game, you lost the war. It's more like gambling. It's a yes or no question. Okay, next, let me introduce some details, the risk about the binary option. Because it's evaluated as a high risk and unpredictable type of investment, many countries and government has banned the binary options. Okay, okay, the dangerous binary option. Well, binary options may be used in a theoretical asset pricing. They're prone to fraud in the applications and hence banned by regulations in many jurisdictions as a form of gambling. Many binary options outlets have been exposed as fraudulent. So because the broker has all the decisions, they can manipulate the company's assets or the price, so it's highly dangerous. The US FBI investigating binary option scams throughout the world, and the Israel police have tied the industry to criminal syndicates. The European Securities and Markets Authority has banned retail binary options trading. Australian Security and Investment Commission considers binary option as high risk and unpredictable. Investment opinion. I'll tell a story because I have some relatives doing something like the binary option. They have lost a lot of money inside this game. Okay, so and we have another other informations. The FBI estimates that the scammers steal $10 billion annually worldwide. The use of names famous and respectable people such as Richard Branson to encourage people to buy fake investment is frequent and increasing. Articles published in the Times of Israel newspaper explain the front of detail, using the experience of former insiders such as job seeker recruited by a fake binary options broker, who were told to leave his concise at the door. Following an investigation by the Times of Israel, Israel's cabinet approved a ban on sales of binary options in June 2017 and the law banning the products was approved by Knesset in October 2017. And since 2018, many social medias such as Facebook, YouTube are banning the binary option advertisement from their platform. You know, the binary option is very famous, but it's also very dangerous because you lost your war. And in other methods of investment, you may just lose 10%, 20% you are not lost all the stake. But in the binary option, you will the lose everything, or you can get a great benefit. Okay, so let's come to the next session. What is binary option? Binary option is come from like the broker will offer you a bid price and you are buying in a strike price. If you are buying an option call, when the bid price is in the ending period is higher than the striking price, you will get a great benefit. But if it's lower than the strike price, then you will get nothing. All your investments are going to hell. Okay. On the other hand, we have a option put. If we're going to do our option put and we paid when the bid price is less than the strike price in the ending period, we'll get a great benefit. In controversial, yes, if the bid price is higher than the strike price, we'll lose the game, we'll lose the stake, and we lost all the money. Okay, so let me tell the examples to help us understanding this theory. A binary may trading 45 bit and 45 is the bit dollars is a target of this game, and the strike price is $50, and we do this transaction in 1 p.m. If we buy the binary option right here, we have to pay $50. If we decide to sell right, then you will sell at 45. Okay, and if you decide to buy at $5, if at 130, the price is over the bid value. Your option expires to become worth $100. Your profit is being made. This is called being in the money. However, in the outside, we may fail because the price is maybe lower than expected. Let's assume it falls to about $40 and we lost the game. And we lost the money we invented. This is called out of money. Yes, all the money has been lost. This is called everything or nothing game. As we know from this example, the binary option is very dangerous. So people are going to do some hedge to help us hedge the risk. For example, the broker will release in different prices. Maybe the price is now for 45 and they will releasing 46, 47, 48 to hedge the risk. So wise investors can invest in different options. They may buy both options call and options put to hedge the risk, because all or nothing is really a highly risky game. And as we mentioned before, the fraudulent activity also happened in the binary option market. Many people just losing their money by the broker manipulate the stock price, the stock assets, or the cash. So it's really a dangerous game. If you are in the game, you'll have to think seriously about it. And there's two types of binary options. It's called cash or nothing or assets or nothing. There, the difference is how they are evaluating the price of options. The cash or nothing, the cash or nothing is happened when they do when they're evaluating the option by the price on the paper. Yeah. And assets or nothing, they do evaluating the option on the assets. And in another way, binary options are option with discontinuous payoffs. It's cash or nothing course, so it may like going off the cliffs. If you win, you are on the top of the sky. If you lose, you are on the hill. Okay, and we have many formulas related to these binary options. And we have many American style, European style, and different things. You can check. We can check the things in the document I have written. I will not introduce too much in the PPT in the presentation because it's too deep. And but we have to mention we use a Black-Scholes valuation to evaluate the value of this option. There are different cash or not. There are differences formulas between the cash or nothing and assets or nothing, call and put. Okay, and we have some skills, because there's many different variations in this option. And there are many regulations from, as we mentioned before, the European, Australian, Belgian, Canadian, and other countries has restrict on the binary options because it's so dangerous. It's like gambling. Okay, so much for this, and thank you for listening. And the binary options are really dangerous, so if you want to do investment, think twice before you make decision. Okay, thank you.
Hello everyone, my name is Qingyun Liu. Today I will introduce the barrier option. The barrier option is a derivative option construct whose returns depend on the value of the underlying asset. They are very similar to standard constructs, but have an important additional feature, barriers. The relevant definition is that the return of the option depends on whether the price of the underlying asset reaches a certain level over a certain period of time. It's called a barrier level. Depending on how the option is exercised, the barrier option can be divided into two types: knock-in option and knockout option. Knockout barrier option means that when the price of the underlying asset reaches the set barrier level, the option becomes invalid. If the price of the underlying asset does not reach the barrier level, the option is an ordinary option. Knock-in barrier option is an option that becomes effective when the underlying asset price reaches a set barrier level. Otherwise, the option becomes void. The difference between these two options is that knock-in requires the underlying security to reach a certain price for the option to be activated, but knockouts are terminated if the underlying security reaches a specified price. Barrier option can also be divided to types, up and down option. If the barrier level is higher than the initial price of the underlying assets, the barrier option is called an up barrier option. If the barrier level is lower than the initial price of the underlying assets, the barrier option is called a down barrier option. So why use the barrier option? The first reason is cheaper. Barrier options are usually cheaper than constructs that do not include a barrier price. Second, lower risk. With knockout constructs, the investment risk borne by the holder essentially ceases to exist if the underlying security moves significantly and reaches the knockout price. Finally, higher profitability. If investors correctly predict the price movements in the underlying security, then they can increase profitability. Of course, the barrier option has some drawbacks as well. The biggest disadvantage of a barrier option is that there is a greater potential for loss compared to a regular ordinary option, as more conditions must be before the option can expire. This option bases on barrier requirements only. If not, is worthless. Then barrier options are not offered to retail investors because they may require a certain minimum size. Finally, because they are OTC entrustments, barrier option constructs are only traded on the OTC market. Therefore, may also have some drawbacks, such as lack of transparency and liquidity. Finally, I will give you some example to explain the barrier option. First one is the up and the in barrier option. If a company stock currently trading at $40, strike price of $50, knock-in price of $60. If you bought the above constructs and the price of this company stock never reaches the knock-in price of $60 before the expiration date, then your constructs would expire without value, even if the stock was trading above the strike price of $50. If the stock price was $60 or higher at the expiration date, then your option would become active. You would then exercise and buy the stock at $50 and make a profit. If you could sell the constructs at some point prior to the expiration date if you were able to make a profit in that way. Second, down and in barrier option. If this company stock currently trading at $18, strike price of $60, knock-in price of $55. If you own the above constructs and the price of this company's stock either went up, stayed static, or didn't fall as low as the knock-in price by the date of expiration, then those constructs would expire. If the stock fell to $55 or lower, then on the expiration date, you would be able to exercise to realize a profit. Second, the third example is the up and out barrier option. If a company stock currently trading at $50, strike price of $60, knockout price of $65. If you earned constructs with the above characteristics, then you would be hoping for the underlying stock to move above the strike price, but stay below the knockout price. If the price of the stock lower than $65 on the expiration date, when you would be able to exercise and make a profit. However, if the stock went above $65 at any time, then the construct would expire with a value of 0. Finally, the example is down and out bearer option. If a company stock currently trading at $60, strike price of $50, knockout price of $40. If you bought constructs with the above terms, then you would be expect the underlying stock to fall in value, but only by a moderate amount if the stock price was lower than the strike price of $50, but higher than the knockout price of $40 at the time of expiration. Then you would be able to exercise to make a profit. If they were cash settled options, then you would receive a payout under this condition. However, if the price of the stock fell below the knockout price of $40 at any time, then the constructs would cease to exist. Thank you for your listening.
Next, I will introduce basket options. Basket options, same as with other options. Basket options give the holder right but not the obligation. So to buy or sell the basket options at a specific price on or before a certain date. Features. The basket options features is where the underlying is a basket or group of any assets desired. The basket can be any weighted sum of underlying values, so long as the weights are all positive. It can be cash settled or physical settled, but cash settled is more common because cash settled is involved with only one transaction. The cost of the basket option is usually lower than multiple single options because it saves on commissions and fees. It has the ability to efficiently hedge risk on multiple assets at the same time. Rather than hedging each individual size, the investor can manage risk for the basket or portfolio in one transaction. Who use basket options? Overall, there are two categories: retail traders and institutional traders. For retail traders, people who focusing on technical system and price patterns indicators, and there are a number of traded shares always be too small to impact the price of securities, are also use basket options. And sometimes there have many retail traders having no access to IPOs or who want to invest in future also use basket options. For some retail traders, they want charging a flat fee, retail marketing fee, and distribution costs, so they will choose basket options. And people who want buying different securities in adequate numbers of shares to achieve a diversified portfolio. For institutional traders, Institutional trader is the primary part of using basket options because institutional traders are making trades for banks, insurance companies, or even hedge funds. And institutional traders focusing on fundamental settlement and trade psychology. It is the largest force behind supply and demand in securities market that could greatly influence the price of securities. And granted by assessed and solicited in IPOS, not only investing in future, but also investing in forwards and swaps. So the institutional trader will choose basket options, and basket options has no any expense and cost. The larger institution fund the market cap, and traders tend to own. Why use basket options? Basket options reduce trading fees since it is only one transaction instead of having to take individual trades on every position in the basket. And it is often traded out the counter and thus can be customized to suit the needs of the clients. A wide range of basket options are available. For example, interest rate, equity, or commodity are related, and basket options allow for balanced exposure and are less volatile with respect to an index. Next, I will introduce other options. The first one is packages. Packages refers to the appropriate combination of standard European call options, European put options, forward contracts, and spot underlying assets, resulting in a new type of portfolio contract. Packages have a zero initial cost option portfolio. So for this circumstance, any derivative can be converted into a zero cost product through deferred payments. Financial institutions often like to design a wrap option so that it has zero initial cost. An example of a zero cost wrap option is a range forward contract, which consists of a long forward with a long put and a short call option. When the strike price equals the forward price, other names for a deferred payment option are Greek forward, Boston option, forward with optional exit, and cancelable forward. Next one is look back option. Look back option. The yield of a look back option is depend on the maximum or minimum price reached for the underlying assets during the life of the option. The return on a European call option is equal to the amount by which the price of the underlying assets at the end of the option period exceeds the minimum price of the underlying assets attained during the life of the option. The look-back option is determined in part by minimum or maximum price of the underlying asset during the life of the option. For example, the look-back option might be equal to the highest stock price minus the strike price over the life of the option, not the final price of the stock minus the strike price. Such an option provides a way to choose the best market timing. If an investor holds a look-back option for an asset that he purchased for X, he can sell the asset for the highest price the asset will fetched during the period, thereby maximizing his possible return. And the last one is Asian option. Two types of Asian options are found in the market. They are average price options and average strike options. The difference from the standard option is that for determining the option yield at maturity, instead of using the prevailing market price of the underlying asset, the average of the price of the underlying asset for a certain period of time during the option contract period is used, like known as the average period. In averaging prices, arithmetic or geometric averages are used, and depending on the underlying computer price, Asian options can be divided into average price options and average strike options. First, the return of the average price option is the difference between the strike price and the average price of the underlying asset in the validity period. And average price, the options are cheaper than standard options because the price of the underlying asset moves less on average over time than the point-in-time price, which will reduces the options risk and thus is time value of money and may be better suited to customers' needs. Second, the return of an average strike price option is the difference between the spot exchange rate at the time of the exercise and the average price of the underlying assets. The average strike price option can guarantee that the average price paid for purchasing frequently traded assets over a period of time is lower than final price. In addition, it can also ensure that the average price charged for selling frequently traded assets over a period of time is higher than the final price. And this is our presentation on exotic options. Thank you for your watching.